Good morning, good afternoon, and a warm welcome to all our guests joining from Europe, Singapore, Thailand, and beyond. My name is Sang Chum, and I am the Chief Marketing Officer of Kim Vietnam here in Ho Chi Minh City. I am delighted to have you join us today for our seminar titled Vietnam on the Verge, Momentum, Reforms, and Market Upgrade. This year, global markets have been rattled by expanded US tariffs and continuous escalating geopolitical tensions. Amid this turbulence, Vietnam stands out with bold structural reforms, what we call Doi Moi 2.0. This new chapter is not only about economic growth, it's about reshaping the nation's future. And with the long-awaited upgrade to emerging market status now within reach, the Vietnam market is stepping into a truly pivotal moment. In today's session, our experts will unpack, one, a quick review of the Vietnam market year to date. Second, overview of the Vietnam macro and market outlook, including the investment themes we believe will define the rest of 2025 and beyond. Third, a quick overview of our Kim Vietnam Growth Fund, our CCOP fund, its performance, and presented by our portfolio manager, Huy. And finally, a very special guest speaker, Ms. Wan Ming Du of FTSE Russell. She will provide valuable perspective on the long-awaited emerging market upgrade by FTSE, hopefully to be announced in October 7th. Vietnam's story in 2025 is not only about weathering global headwinds. It's about transforming risks into opportunities and positioning the market and the country for the next phase of growth. So, for the next part, we will take a quick look at the Vietnam market year to date. As you can see, Vietnam has been one of the top performing markets around the world. According to our analysis, among the major indices globally, Vietnam currently ranks second with almost 34% year-to-date return in local currency. Closer to home around the region, you could also see how strongly Vietnam has performed. Compared to our neighbors in Indonesia and Thailand, which has suffered some political instability in the year, you could see a clear outperformance and standout performance by Vietnam in terms of stock market returns. And taking a closer look at the VN index performance, I believe there's about 5 drivers that have led to its strong stellar growth. First, economic growth. GDP growth in the first half of 2025 clipped at 7.5%. Q2 GDP growth was 8%, and we are projecting 8% GDP growth for the full year 2025. Government reforms. We will talk about this in detail in the presentation, but the government has, with maximum efficiency and with speed, been able to develop new regulations and reforms to really support and unleash the private sector growth. Third, solid earnings growth. We saw in 2024, we had corporate earnings growth of almost 20%. In 2025, we also project earnings growth of almost 20%. And looking forward to 2026, we expect earnings growth to be nearly 20%. So extremely consistent and strong earnings growth. Valuations. In March, we talked about valuations being extremely attractive. At that time, valuations were about 2 standard deviations below the historical mean. However, given the stellar performance year to date, the valuations are not as attractive, still trading below the 10-year average. Currently, the 2025 forward PE is 12.8 and PB is 2.0. And lastly, the potential market upgrade to FTSE. Again, we have a guest speaker, Ms. Wan Ming Du, who will give you a first-hand perspective on that process and what we can expect, hopefully on October 7th, when the announcement is made on the possible upgrade.
Hello everyone, thank you for joining us today. My name is Kan from the research team at Scheme Vietnam. In today's macro outlook, it's not only about this year and next year, but also about the Vietnam long-term strategic plan to 2045. This year, Vietnam's story is one of resilience and transformation. The economic growth remains robust, driven by construction with the public investment acceleration and the real estate recovery, while resilient domestic consumption continue to drive the services. At the beginning of the year, tariff dominated the headline, but what truly catching the headline more than the tariff this year is Vietnam reform. We call it Đồi mới 2.0, which is bringing a lot of changes in the economy and society. We have seen decisive restructuring of the institution to create a lean government, enhancing efficiency, unleash the private sector, and digital transformation to increase the productivity. In short, this year's growth is showing remarkable resilience, but the reform is even stronger. It's not just developing Vietnam today, but receiving the future. Let's dive deeper into each of these topics. The economic growth this year is robust. After the second quarter GDP came out higher than expected, we revised our forecast up from 7 to 8%. This growth comes from the powerful combination of the three key pillars: manufacturing, supported by the continual export growth; construction, the leading driver this year, with the public investment and real estate recovery; and resilient domestic consumption, pushing the services expansion. Behind these drivers is the decisive move by the State Bank of the Vietnam, easing the policy, keeping the rate low, and expanding the credit. At the same time, the government is very important in this. They are really the one driving the changes, pushing infrastructure and innovation, laying the foundation for a higher than 8% growth in the year ahead. We will discuss further what they have done this year on the next slide. Do you remember the Đồi mới 1.0 in 1986? The first reform 40 years ago, aimed to opening Vietnam to the world, attracting foreign investment, and driving the export. In truth, we did it successfully. From humble beginning, Vietnam has developed to become the global manufacturing hub, exporting the smartphone and high-tech products to every corner of the world. The increase in export and the FDI clearly reflected the extraordinary reform. Now, Đồi mới 2.0 marks a new chapter. This is not simply about opening up, it's about unlocking productivity, strengthening domestic enterprises, and integrating technology and digitalization. And what we have seen this year is a lot of changes. Institution reform, the government is moving from control to support. The private sector is now recognized as the most important growth driver. And the digital transformation is no longer a concept. It's happening in government, in companies, and in their everyday life. At the same time, Vietnam is investment heavily in research, technology, and innovation. The objective is not just to assemble the smartphone, but to design, to create, to move up the value chain. Đồi mới 2.0 is more than the economic. It's a vision of Vietnam as a nation with modern infrastructure, advanced technology, and the thriving private sector, where every citizen can live in wealthy, creativity, and high technology. This is just the beginning of the journey to become highly income developed nation by 2045. Đồi mới 2.0 is the engine that will carry Vietnam toward that future. One of the radical moves this year is create a leaner government. The Vietnam have reduced more than 60% of administrative units cut nearly 250,000 civil servant jobs and consolidated the provinces while removing digit level of governance and just the two-tier system from province to communes. This restructuring is expected to save $190 trillion in payroll over the next 5 years, which will be allocated to the public investment. In parallel, the money for workforce compensation will stimulate the consumption. We estimate overrun of this would add 0.5 to 1% to annual GDP growth in the next 5 years. Consolidation also accelerates decision making. With a fewer local approval, multi-provincial projects can move faster, and the large provinces are also easier to capture investment opportunity. Let me wrap up this slide with two keywords. A leaner government is not only a cut the bureaucracy, leaving more room for investment, and the province's consolidation is also push of the economic scale and increase the productivity. The private sector is the most important growth driver of the economy. It's not just a declaration, it's a decisive shift in the mindset. 4 key resolutions, 57, 59, 66, and 68, have been introduced to unlock its power, making the business easier to access the capital and land, offering the tax incentive and supporting the technology adoption and digital transformation. For the large private company like Vingroup, Techcombank, it means more opportunity to grow, to join the national project. For the government, reform means supporting the company to do more and not having to worry as much about the regulation, allowing them to focus more on the business. On this reflect a trend for the government from the past focusing on the control and now facilitating the growth. Just a few years ago, anti-corruption dominated the headline, causing a lot of concerns. But now they are talking about how to double the number of private companies to 2 million by 2030, lifting their share from half of the GDP to the 60% of the GDP. And to achieve the breakthrough in growth, the new economic model will not only rely on the capital, but also on technology and human capital. Today, we are seeing a sweeping transformation, a comprehensive digital transformation this implemented a few years ago, now taking shape to build a digital government, digital economy, and digital society, enhancing governance, efficiency, and labor productivity. This year, 2025, is the real milestone, seen on the data of the citizen IDs, bank accounts, tech account, etc., interconnected with the national system, laying a digital foundation for the future. At the same time, Vietnam is increasingly investing in education, research, and technology application in every corner of the nation. Now there even the growing discussion about building more data centers and taking advantage of the AI revolution and blockchain technology to drive the efficiency and productivity. On this move aim to increase the total productivity contribution from 40% of the GDP today to the 55% by the 2030. This is how Vietnam to leap forward in the coming decade. With that, I will hand over to my colleague Huy, the SICAP Portfolio Manager, who will share how this transformation are shaping the stock market and our key investment team.
So in this part, we are going to look at the outlook of the market and some attractive investment themes. There are 4 main ideas in this section. The first one is the update of the EM upgrade. The second one is the government action on the private sector. The third one is the digital asset. And the final one is the earnings growth. On the 7th October, the FTSE will announce the result whether Vietnam will be upgraded to emerging market or stay the same at the frontier market. The consensus is quite high that Vietnam will be upgraded. It is estimated that when Vietnam is upgraded, there will be around 1 billion US dollar money flow from the passive ETF and about 5 to 6 billion US dollar from the active fund coming to Vietnam. Looking at 2026, the relevant bodies are planning to allow intraday trading, which will increase the trading volume significantly. The market also talk about trading through lunch hour as well. And looking at the 2027, according to the roadmap, the central counterparty clearing mechanism will go live in the Q1 2027, and Vietnam will be included in the MSCI EM watchlist and expected to be upgraded in 1 year after that. The money flow from MSCI will be much bigger than the FTSE. With the resolution 68, the government is trying to build a high quality and global competitive private sector. The government is trying to build companies like Korean Chaebol in 1970s. Those private companies will have tax support and loan subsidies. The goal is to have at least 20 large enterprises being integrated into the global supply chain. It will help Vietnam to avoid middle income trap and become a developed high income nation by 2045. You can see that some of those private companies are listed on the stock exchange, such as Vingroup, Techcombank, Harvard, and FPT, and we own those names in our portfolio. Another big thing happening in Vietnam is the law of digital technology industry, which will legalize digital assets and will be effective from the 1st January 2026. According to Wall Street Journal, Vietnam is the global top 4 trading crypto in Binance, with the estimated monthly trading value of 20 billion US dollar. That is about 60% of the Vietnam stock market liquidity. And some people even say that the trading value is even higher than the stock market. It is estimated that 17.4% of the population owns crypto, higher than the 10% of the stock market. As such, when the government legalizes crypto, there will be a lot of millionaires overnight. This will help boost domestic consumption and economy. It is expected that there will be 5 companies running 5 exchanges, and some of them will be security company and bank. As such, there will be a huge opportunity for those brokers and banks. We forecast the market will have the earning growth of 20% this year and 17% next year. We have revised up our earning forecast compared to our forecast earlier at the beginning of this year. This is thanks to all the supportive monetary policy of the government. Our earning growth is among the highest in the region. We have identified 4 key investment themes. The first one is the private sector that benefit from the support of the government. These private companies include Techcombank, Vingroup, and Masan. We forecast that net profit growth will be about 10 to 12% CAGR in the next 5 years. That is double the earning growth rate of the last 5 years. The second sector is the broker sector, which will benefit from the EM upgrade, the day trading securities, and the crypto trading. The third sector is the consumer sector, who benefit from the rising trend of modern trade, which is currently only about 12% in Vietnam, compared with 23% of Indonesia, 28% of Philippines, and 49% of Thailand. The final sector is the company benefiting from the rising public investment. It is a very important factor for the government to achieve the GDP growth target. Thus, it is a must-have in our portfolio. Now, let's see how we have capitalized on this at King Vietnam. For those who are new to us, I would like to introduce our SICAV fund, the King Vietnam Growth Fund. A little bit of introduction about myself. My name is Huy. I'm the portfolio manager of the SICAV fund. I have 15 years of investment experience in Vietnam, which include 7 years of the portfolio manager and 8 years of sell-side research analyst for both local and international broker. Currently, I manage the SICAV and 1 Korean fund and other mandate account. The total AUM under my management is about 300 million US dollar. About SICAV, the fund has about 50 million US dollar in AUM. The fund is to capture Vietnam's growth potential. The fund applies both the bottom-up and top-down research, but mostly bottom-up research. The fund focuses on mid-cap stock, where we attend hundreds of meetings every year, trying to look for those investment opportunities that can differentiate us from the other funds. Looking at the longer term, we are up by 95% since inception in January 2018, beating the index by 55%, and our 5-year return of 148%, beating the index by 80%. Our 3 years and 5-year performance rank best among peers. This is a track record built on strategy, not just market luck. This is thanks to our portfolio model, which promotes teamwork. Our fund does not rely on a single star analyst or a single PM. Additionally, we have the support and the cooperation from our headquarters in Korea, which we can leverage their knowledge and information about the world financial market. This is one of our key competitive advantages. Incorporating all the catalysts and the investment team, we have discussed about our portfolio comprises a private conglomerate such as Vingroup, Techcombank, and brokers such as SSI, and consumer such as Weber, and material such as Alpha Group. And most importantly is the banking sector, which will fuel the need for capital of economy in the next few years. Next, our special guest will share her insight on the upcoming emerging market upgrade. Stay with us.
Thank you, Hui. As we mentioned in the original agenda, we have a very special guest speaker today, Ms. Wan Ming Du from FTSE Russell, joining us online. Wan Ming?
Thank you, Sang, and hi everyone. Very nice to be here today. My name is Wan Ming Du. I'm from FTSE Russell. So today in my session, I would like to cover two main areas. The first one will be the FTSE equity country classification process. So I would talk you through how FTSE actually evaluate the country and then the process of either promoting or demoting a market. Then I would like to spend a little bit more time on Vietnam in terms of the progress that Vietnam has achieved so far, and then the status where we are in terms of the evaluation on the market. So let's just take a step back and maybe look at from a process perspective. So the FTSE equity country classification process actually launched in 2004. So that's been over 20 years ago. There's a pretty long standing history in terms of how we actually classify markets and how we actually engage markets in terms of their classification. So just from a very high level, we classify the market into 4 categories. So these are the developed, advanced emerging, secondary emerging, then frontier. So just to give you a bit of information, in terms of, I think the latest number that we have, we actually classified 48 countries within the developed, advanced emerging, and secondary emerging status. Then we have further 30 country or markets classified as frontier markets. So that's what we cover in terms of the universe, so to speak. Now, the market that we are evaluated, I want to stress that we are basing from the international institutional investor perspective. So that's very important to know, because FTSE Russell, as a global index provider, we represent the international institutional investor community. So what it means is, some of the criteria that, you may see as, for example, a domestic institutional investor, it works for those investors, it might not work for international. Then it's good to understand that we actually representing the stance from the global investor perspective. And then the second thing I want to mention is we are basing our evaluation on the accessibility perspective. So what it means is, from institutional investors, how they assess to the market is really the key focus. So we don't look at the relevant wealth or the credit risk or any geopolitical tension, for example. One of the key measures that I wanted to mention is what we call the FTSE quality of markets. Now, this quality of market is important matrix that we look at, because ultimately, we wanted to introduce something, or we want to use something that you can judge or you can actually compare objectively across the peer markets. So this is what really the key, I would say that the key principle of how we look at a market. So within this quality of market matrix, there are 22 criteria that we look at. And these 22 criteria is really focusing on, for example, in terms of the regulation, the quality of the regulation, the dealing landscape, custody and settlement procedures, and the presence of a derivative market, for example. So these are kind of on the broad areas that we cover. Now, this quality of market matrix also constantly evolving in terms of relevant market developments. So we ensure this matrix constantly reflects the developments in the market, so we can actually have the most accurate matrix we can use to evaluate markets. One thing to add, we also look at the GNI published by the World Bank, just as an indication as well. So this is part of the assessment, but this isn't something that FTSE evaluate. This is something that we will take World Bank's data as a reference. And lastly, as part of the framework, I wanted to mention we do have a minimum threshold in terms of the investable market capitalization and also the eligibility security counts requirement. So let me go to the next slide so you have a little bit more color in terms of, if we look at, let's say, secondary emerging market status, what they actually require to be classified as a secondary emerging market status. So we need the GNI rating to be at least lower middle, or and a credit worthiness rating to be no lower than a speculative grade. So that's one requirement. Now the key, as I mentioned, the quality of matrix, the quality of market matrix. A market has to pass 9 out of the 22 criteria as set in that matrix. So secondary emerging markets is 9, and then we have developed has to pass all 22. The advanced emerging market has to pass 16 out of the 22. In terms of the size criteria, to become a secondary emerging market status, the market has to have a collectively investable market cap greater than 10 basis points of the FTSE Emerging All Cap Index, and a minimum of 5 stocks that pass the eligibility screening. To be retained on the secondary emerging market status, the asset level is, if collectively the market fell below the 5 basis points of the FTSE Emerging All Cap, or the security count falls below 2. So just to give you a picture of, these kind of specific criteria when we look at secondary emerging market status. Now, I wanted to also talk a little bit more about the process itself. So the process is I would say we really focus on rule-based, but the engagement is also important. So, and then the transparency. Now, the transparency is really to be in line with how we actually look at index. So if you like, the principle of FTSE running or maintaining an index is to be rule-based and also objective. The principle of how we actually look at a FTSE equity country classification also in line with that principle. So we need to bring in this kind of transparency. So to ensure that transparency, so investors has no surprise or also have an idea of what FTSE is currently look at for a country, we created this so-called watch list. So this watch list is to enable investors to be able to plan ahead and looking at potential classification, either their promotion or demotion. So now, how do you actually becoming a watch list candidate? Typically, this watch list candidate will be, they have a score against the quality of matrix, market matrix, has been, judged to have met or close to meeting the technical criteria required for a reclassification, either again promotion or demotion. So to emphasize is, they are very close to the potential reclassification. So for those that are far from it, we typically just keep it, under the radar. If a country gets on the watch list, that means they're very close to becoming a, potential reclassification. Now, the engagement is super important in this process. So we have a number of advisory committees that we use to, as a sounding board in terms of their experience in trading the markets concerned. So those two advisory committees are the FTSE Equity Country Classification Advisory Committee, and then also the FTSE Russell Policy Advisory Board. Now, these committees, we host meetings every quarter. So every quarter we get together, we'll discuss their experience, we discuss markets in terms of their hurdles or improvements from the market. So then we can actually have the most up-to-date feedback from the market participants. And also I wanted to mention, the engagement with the local market authorities are also important. So they are aware of what needs to be done to meet the international standard. And I think one of the things I think is super important, having this process is to ensure the, the market that we are looking at, the market we potentially get reclassification is able to understand, what is the best practice from the international standard. So the engagement is super important as part of our process. Now, in terms of the timeline, I wanted to mention, because timeline is very important in the way how we assess the market. So our process really operates according to an annual schedule, and typically starting from the October of the year and then finishing the following September. So it's like a 1-year process. This process pretty much starts with a very in-depth assessment of those markets that place on the watch list. And this watch list, we actually publish every year. So we'll work on this once we publish it. And then throughout that 1-year period, we'll work on all of those criteria that needs to be, passed to be or fail, or potentially what needs to be worked on to trigger a reclassification. Now, during those that 1-year period, the quality of market scores for the current and potential watchlist countries are reviewed by the FTSE Equity Country Classification Advisory Committees. So we will discuss this in the meeting, and then we basically will also discuss this with the local market authorities as well. So when we comes to the annual review, which is in September, FTSE will recommend either for a country promotion or demotion, if any, presented in the annual September FTSE Equity Country Classification Committee, then subsequent with the FTSE Russell Policy Advisory Board for affirmation. So ultimately, after those committee meetings, FTSE will take a independent decision based on our rules and also the feedback that we received from all those committees in order to arrive a decision. And that will be published in the October timeline. For this year, it will be in the Tuesday, 7th of October, 2025. One thing I wanted to mention is we definitely will allow sufficient time before an announcement and implementation. So we implemented this so-called minimum 6 months advance notice. So typically, a market would have to fulfill that 6 months period in terms of the notification to our clients before an implementation is actually executed. So in the past, we have done some markets has 6 months notice period. I think more broadly, most of the market are subject to the 1 year advance notice periods. So now that we gone through the process, let's have a look at how Vietnam is doing in terms of scoring across the quality of market matrix. Now, so I mentioned Vietnam, has been on our watch list for quite some time. That was since 2018. For a possible reclassification from a frontier to secondary emerging market status. So, as you know, this quality of market matrix for qualifying as a secondary emerging market status, a country has to meet 9 out of the 22 criteria. So if you look at these slides, Vietnam actually passed 7 out of the 9 criteria. The 2 outstanding criteria still remains settlements, which is the cost associated with the failed trades, and also the settlement cycle, DVP. So at this moment, these 2 criteria are restricted, rated as restricted. They need to get a pass for reclassification. At this stage, we are still seeking market feedback on those 2 criteria. My understanding is, so we have the MPF model, which is to address the pre-funding requirement that's needed for international investors. And then after the introduction of the MPF model, there's also a fair trade process that's being introduced. Again, those 2 market developments, we currently actively seeking market feedback in terms of their experience. So I mentioned we are focusing on the institutional investors' experience. So from their perspective, whether the MPF is working as sufficient, whether they, when they compare with other emerging market, they satisfy in terms of, the pre-funding criteria, similar to, what they do in other emerging markets. So that's currently being, we are looking for feedback with international investors as we speak. So this is where we are. And I wanted to also touch on, if Vietnam were to be promoted, what does it look like from a, index representation perspective? So first of all, if Vietnam were to be promoted as things stands now, within the FTSE Emerging All Cap Index, we projected Vietnam would represent around 0.3% of that index. So, that's it's also quite a not a small weighting if you look at the kind of composition of the index. It's actually bigger than, for example, in Asia, I think it's just below Philippines, and in other market is above Colombia and Czech Republic. So it's not a small size per se. And when we look at potential fund flow, because of the size, we projecting potentially there will be around 800 to 1 billion passive inflow index tracking that come into the market as part of the inclusion. So I'm gonna pause here. So this is my sharing, and I hand it back to Sang. Thank you.
Thank you, Wan Ming, for your very informative and insightful presentation. Perhaps we could spend the next 10 minutes on a Q&A session. First question, in terms of capital reforms in Vietnam, Vietnam implemented the non-pre-funding model last year, November 2024. What has been FTSE's evaluation of this implementation and execution of the non-pre-funding model, and what has been the feedback so far from market participants?
Thank you, Sang. So I'm, in the absence of CCP, I know the SSC is looking at, the medium long term, hoping to introduce the CCP. Now, in the absence of the CCP, the MPF model was introduced, as you mentioned, last year, November. Now, this MPF model, first of all, is unique to Vietnam, so we don't actually see this in other markets. But essentially, this MPF model was enabled the local broker to provide a credit line to foreign institutional investors, so that they don't have to have the cash in hand when they place the trade. So the objective is to remove this pre-funding requirement. So I think this is at least a step in the right direction. Now, because it's unique, so what it means is, we can't actually use other markets kind of experience to say whether this works or not. We really rely on the real practical experience of the market practitioners. So we have had some feedbacks in the past, and also right now there's our understanding is the adoption rate is growing for MPF. So we have spoken to some of the investors have used the MPF. I think majorities have reported no major concern. There are definitely some, I would say, the consistency across brokers in terms of the limit they can provide to particular clients. It'll be great to have that alignment to the market, because whether you're big or small in terms of your size, I think it's important to actually apply like a fair and consistent approach to all the clients. So that's one thing. The second thing that was raised to us in terms of improvement or potentially concern is the capacity of the broker community to be able to absorb that 1 billion, 800 to 1 billion inflow on the rebound day. So that's extremely important, because we're talking about these are not active funds. Index is representing passive investors. So when they come in, they have to come in a particular time window, because they need to follow the index very closely. Now, whether the broker has that capacity to support the clients, for the rebound day, this is one of the things that we have to continue to engage with our clients with, and also the local market players and the regulator. Because ultimately, when any index provider, they implement any inclusion, first of all, I think we cannot, we need to be considerate of, we're not causing any disruption to the market, and also introducing any risk to the market too. So these are becoming a very important topic when we talk about the, potential how we actually implement those inclusions. So in the past, if I could just maybe use some of the example, in Asia. So China Asia, obviously, when we included in 2019, that was even inclusion factor, we introduced the 25%. So we are not even including the entire company. It's only 25% of each of the company's investability weights. Now, the China weighting was very high. It was 6% of the China Asia, 6% of the FTSE EM all cap. So we actually have to do this in tranches in order to, mitigate any potential issue that may come along with the inclusion because of the sheer size. So that's one of the things we would do when we talk about implementation, the how, and ensure a smooth transition.
What is also very unique to Vietnam is the FOL, foreign ownership limits placed on certain sectors and companies. How does FTSE view FOL? And in terms of index construction, how would that work for FTSE?
Okay, thank you. So in terms of the FOL, so we, as an index provider, we actually respect each market has their own stage of development. So FOL is a measure that, typically the authority to use, right, to keep a limit for a foreign investor to be able to hold, of a company. Now, we have seen this across APAC and even, still some of them in Europe. Certain sectors are subject to FOL. In Japan, the media, the aerospace, I think in South Korea as well. In China, there's a blanket of 30% FOL to foreign investors. And even in India, they recently only just went to the sector limit level for listed companies. So in a way, FOL is not unique to Vietnam. It's not it's not a criteria we would say because you have an FOL and therefore, you have to completely open up before you can qualify. Now, what it matters for an index inclusion perspective is we need to ensure individual company has we call the so-called the sufficient foreign room, meaning the foreign portion that of a company that's allowed for foreigners to hold, and how much is still left, for foreigner to actually buy. So that's what we call the foreign room against the foreign owner limit, right? So individually, we'll look at the company to see what is the actual room for foreigner to buy. So we set a threshold for individual companies to be qualified for index inclusion, which is 20% foreign room to include, and then 10% for an existing company to come out if it's below 10%. So we do this on an individual security level, meaning, each company has to pass that to be qualified. So when it comes to Vietnam, so the companies that has little room, foreign room, they might not get into the index. So that's the impact that we would potentially see in Vietnam if it get upgraded is you have 1,600 listed companies. Some of them not able to get into index because of size. I would say a lot of companies could not get into the index because of the insufficient foreign room. So I would say that as a market, definitely need to work on that, because if you ultimately, getting promotion is just the first step. You want more representation in the index, the foreign owner restriction need to be addressed.
Thank you again, Wan Ming. I think we're a little bit short on time, so we'll end the session here. But again, very much appreciate you joining us for our session, and we look forward to your announcement on October 7th. Thank you.
Thank you. Thank you for having me.
Thank you, Wan Ming, Hui, and Khan, for sharing such insightful perspectives today. To wrap up, Vietnam's 2025 story is one of resilience and opportunity. As our head of research, Khan, highlighted, GDP growth remains robust at 8%, with reforms under Doi Moi 2.0 reshaping institutionals and empowering the private sector companies. Our portfolio manager, Hui, showed how these reforms, alongside supportive monetary policy and technology integration, are translating into solid earnings growth and exciting investment opportunities. Wan Ming provided valuable color by giving us a first-hand look at how Vietnam is being viewed globally and what an emerging market upgrade could possibly mean for Vietnam and the Vietnam market. I believe Vietnam has high ambition to join the world stage and play a significant role in international markets. And I believe Vietnam has taken very strong steps to achieve these goals. On behalf of our entire team, thank you once again for your trust and engagement. We look forward to staying connected and continuing the conversation. Until then, we wish you a great day ahead and happy investing. Thank you.